Hey fellow traders, today I'm just going to show you how to read the charts quickly. If you're a beginner, this is really going to help you. It's going to get you ahead. For those of you who don't know me, I'm Rob, and for those of you who do know me, I'm still Rob. It's Coffee with Rob. Let's have a sip of coffee and let's get started on the chart. So I'm going to take you to the charts quickly. I'm going to show you how you can identify on the charts the easiest way possible to make a living. But before we start, let me tell you a little story. A little story about charting that I started with 30 years ago when I started trading. Way back when, way back in the old days. Yeah, we'll call it the old days if you want to. I'm not going to give my age away. But back then, we didn't have computers, we didn't have algorithms and factual things and maths and all that sort of stuff involved in the trading. What we did is we had a little piece of paper with the prices on. And I would measure the prices daily from a newspaper. I would take a newspaper. I go and buy the Pretoria News because I lived in Pretoria back in those days, 30 years ago. And I'd go and buy the Pretoria News in the morning. I'd go and buy the Pretoria News in the afternoon. And there was a business section inside the newspaper. And then I would take that business section. I'd write all the prices down of my shares and whatnot. And then in the morning, I'd phone the broker and buy my shares or sell my shares. That's how it went. Every day, check the prices. Note the prices down. Grow your charts. I mean, you couldn't follow all the shares. You could only follow 10 or 20, maybe 30. Some guys were following maybe 50 or 60. But back then it was really, everything was put in manually. So we used to sit and draw those charts. And then I would literally draw what I called a 20-day average. But it was a straight line through the chart. That was my break point. So if it went above that point, then I would buy. And if it went below that point, I would sell. And that's as simple as it got. I didn't trade Forex, I didn't trade commodities or index or anything like that. All I had was shares. And there was no geared trading. We trade with real money. We had just what I put in is what I had. So the money you had was all you had to trade with. That's what you traded with. There wasn't anything else. There wasn't all this 100-to-1 geared trading and funded markets and all the rest of it. By the way, if you want a funded account, drop down to the description. I do have one there for you if you want to use it. But what I'm going to show you here today with these charts, I mean, if you look at that story, is based on how I started trading. Along came all these fancy indicators, all these fancy systems, computers came along. We dreamed of having computers back in those days, and when they came along, it was absolutely amazing to have this system that you could use on a computer. But when computers first came out, understand this, we still had to feed the information in. We still had to, just like we did on the pen and pencil, we had to feed the information into the computer. It wasn't online like it is now. We had dial-up computers. I wonder if I can still remember the dial-up noise. Oh, yeah, I can't remember, but you know what I'm talking about. It would dial up on your telephone, you know, those dial telephones. That's how we got online. And then you wouldn't stay online permanently. You would go on and off because it was so expensive to be online. Things were different. Now, that kind of trading makes one realize psychologically that it's not the charts that make your money. That the market is subjective, not objective. That the market's not made up of maths. The market's not fractal. The algorithm's not chasing you around. I'm going to do a video on how the algorithm works. Because you know what it actually is, guys? The story is this. The market is made up of human beings. And when you look at a chart and when it moves up and down, what's moving that chart up and down, do you think? Do you think it's maths? Do you think it's an algorithm? Do you think it's a robot? No, it is human beings. Human beings are moving that chart up and down all the time. That's what it's about. So if you want to now get into the market and think that it's going to be some kind of objective thing, you're making a big mistake. Because effectively, it's not objective, it's subjective because you're relying on what another human being is doing. Fortunately, human beings are creatures of habit. So when you look at a chart, you see what happened in the past, and in all likelihood, it'll probably happen again in the future because some human being is behind everything. Even if it's a bot trading, there's a human being that's invented the bot. Or if the human being is trading for real, it's a real human being. If it's a big company, if it's the big money, if it's the whales that are trying to get you out of the trades and spike you out of the trades, there's a human being behind it. There's human beings trading behind it in the markets. So that's what you have to understand. So that's my little story. And the story goes like this, guys. The market is 50-50 because the market is very subjective and it's made up of human beings. You would agree with me if we tossed a coin 10 times, the high probability is you would win 5 and lose 5. What you want to do is you want to make more on the winning trades and lose less on the losing trades. The 5 that you win, if I said to you on the coin toss, the 5 that you win, you get 2. And for the 5 that you lose 1. Anyone would take that bet. And that's what it's about. People always think that a win rate is going to make them money in the markets, but a win rate is not what makes you money in the markets. A win rate is something you can boast about, but it's not going to make you profitable. Now, the profitability strategy is in my previous videos, and we'll go over that in the other videos. But today, I'm just going to show you a quickly how you can read the charts and the best way that you can read the charts. And to do that, let's go and have a look quickly. Don't forget, you can go and get your free Forex book down in the description below as well. Just out of interest in case you want one. Guys, don't forget, the markets are risky. Most traders do lose money, and if you're unsure, you shouldn't even be trading. I just thought I'd bring that up because you guys need to know that. You need to know that trading is effectively quite risky. Let's go and have a look at these charts and let's go and see what we can do with them. Guys, this is the Funded Trader account that I use for the live shows and that I use for the members. We call ourselves the A team. Everybody gets to choose trades on here. We trade together. We see how the trades go. So if you want to join us on the live shows, normally Tuesdays and Thursdays, and if you want to be a member, you can join below as well. But you don't have to be a member to be on the live show. Anyone is welcome on the live show. And we all trade together and we have a little bit of fun together. So this is the New Zealand dollar, US dollar. We took this trade this morning, but what did we look at here today? Let me just take this out of the way. So we've got a nice big chart. We've got a nice big chart here. What we looked at, now what we normally do to get any information is we take it to a line chart so that we get the closing prices. And then we also just take it up to the daily. Why do we take it to the daily? Because the higher the time frame, the more reliable the information. The lower the time frame, the more unreliable the information. And if you don't understand what I'm saying there, I'm going to simplify it for you. Imagine you're testing a system and you put 5 traders in a room to see how that system works out. And 3 of them win and 2 of them lose. You're going to go away with a sample of 60% success. You're going to say, well, that was pretty good. That worked out quite well. But your sample size is really, really small. And you don't know. Those 5 traders might be the best traders in the world. You just don't know what you got. Or the 3 that won might be the best and the 2 that lost might be the worst. But if you took 100 traders and put them in a room and tested the same system, you would get a more reliable result. Because let's say 80 of the traders lost. That would tell you you've got an 80% chance of that system not working. Because you've got 100 traders that have gone in there and tested it. Let's be honest, if you put 1,000 traders in, you'd get an even better result because there is a point where, thinning it out too much is a waste of time. But you get what I'm saying here, you understand. I'm looking at the size of the sample. The bigger the sample, the more accurate the information you're going to get out of the system. When you go to a day trade, when you go to a day time frame, there's a lot of information in every candle. There's a lot of information in every closing price in every day because it's a whole day's trading. When you go to a 5-minute chart, you've only got 5 minutes of information. It's not going to be as reliable, is it? Yeah, you can trade on it and you can pick a point and you can use the strategy to work out where you want to be, but at the end of the day, it ain't going to be that reliable. What I did with this particular trade is I simply drew a trend resistance line down here because I can see the trend is bearish, and I used the closing prices to do it. And there is 3 touches, 1, 2, 3, for those of you who are fussy about the 3 touches. But clearly that's a bearish run. Effectively, I didn't draw in my support and resistance, but you can, if you like, you can draw in the resistance here because there is a clear resistance level up here, and that resistance level will give you an idea of where if it gets to that level, you can decide whether you actually feel comfortable staying in that trade. There is also a support level down at the bottom here, which is developed, but I'm not even going to draw that in. I'm just going to leave the resistance level at the top here. Then what you do, take it back to the candles, take it back to the 4 hour, because the 4 hour is where you want to trade. Now you know, look, my target is actually up here at 59.5. It's a little bit above this level, because there is another level up here. But if it gets into this level, I'll have moved my stop loss up. I'll be following it with the strategy. Please go to the previous videos and watch the strategy, because the strategy is the most important thing that you're ever going to learn. Once you understand that charting is not what's going to make you your profits. This little 10 minutes of charting that I'm showing you here, that is just a high probability trade. It's how to read the charts. But at the end of the day, you need a strategy and you need a psychology to win in the markets. Please understand that. Don't forget that. Okay, so I did have a level in here of support previously. It is still there. And we've got the resistance level that we've put in from the day. So what that tells you is if you get a green candle out of there, you can effectively go long. And if you get a red candle out of there, you can effectively go short. If you get a breakthrough, for example, the price breaks through a level and it comes back to retest, then you can carry on with that direction. That's short, for example. If it breaks through the other way, if it breaks to the upside and goes through this, goes back to retest, you can take a good long trade. The reason we took this trade long is because it broke through this trend resistance and it's heading to the upside. Now, we did previously take this trade. We took it when it broke through the trend resistance, but the resistance was a little bit lower and we took it somewhere over here, but then it broke back down and it failed. Trade failed, and that's why you have a stop loss strategy. Follow my strategy in my other videos. Please go and watch the strategy. It's after every charting package that we talk about. But today, the video is going to be too long if I start going into strategy. So you just need to watch the other videos. This is broken to the upside. It's given us a green candle. So we've taken a long trade on this with a view to it carrying on up. What we'll do, we'll use the strategy. We'll take our stop loss. Once it moves into a decent profit, we'll move our stop loss up to break even, and then we'll follow the profits up. We won't take profit when it gets to the profit level. We'll move our stop loss right up behind it and we'll take the profits. Because as you guys, the guys that know me will know, I only believe in strategy. Systems only give you a high probability trade. Win rates are useless. All that win rates do is they tell you you've won 7 trades out of 10. But if you won $70 on the 7 that you won and you lost $300 on the 3 that you lost, what's the point of a win rate then? There's no point in it, is there? That's how we read the charts. Here's a gap. For example, it gapped down. A lot of people say to me that gaps are, what's the story about gaps? Well, gaps are actually quite important in the markets. When you see a gap like this, it usually happens because there was a close and then a reopen, which means it's spiked quite far down. A gap will always close. The way people get this wrong, because they think, no, they don't always close. They do always close. It's just a question of when. Gaps don't necessarily close immediately. They don't close the next day. They might not close the next week. Sometimes a gap can take a year to close. Guys, gaps don't close immediately, but they will close eventually one day, sometime. Be aware of that. That does happen. It's just a natural phenomenon in the market. But we don't trade gaps. What we trade resistance, we trade support, we trade trend resistance, trend support. That's it. The easiest way to trade. If it breaks this trend resistance, now we go long. Now we watch it for a trend support. So what we do, we can draw another trend line in here. I know it's not the most fantastic trend line, but it is a trend line. Still a trend line after all. And now what I do is I monitor it simply by, if it comes back through that line, I need to be cautious. I need to look at it. It could be turning the other way. Because once it breaks through a trend resistance, it's going there. This is a counter trade. There's 3 ways that we trade these charts. The first way is we trade with the trend. Trend is your friend. The second way is we trade in a range. This is a range. There's a resistance and there's a support. It trades between those two. That's a range. Then we counter trade. Counter trading can be the most difficult one, but it can also be the most fun and the easiest one. Because think of this. Counter trading is as simple as this. You have a trend resistance in. It breaks through that trend resistance, gives you a green candle. You've broken structure. You're buying long. You're going against the trend, but the trend has changed. So you're counter trading, and you're counter trading based simply on the fact that it's broken structure. It's broken that resistance and it's going the other way. So now we're long. If it comes back and breaks the support, then we know we could be going the other way again. Just draw that line in and keep an eye on it. Yeah, we could have taken the trade from down here with this green candle coming out of the support. But my caution was that it had fallen so hard, caused that gap, spiked down, and it looked extremely bearish and weak. But it did recover, it did close that gap, but then it started to come down again. So at this point, my concern was, will it or won't it? So I waited for it to counter trade out of the bearish trend, through the trend resistance, heading on to the upside, and that gives you a good structure. That's, trading charts can be really easy. At the actual charting, you can teach to a primary school child. What you can't teach is the psychology and the strategy that we use in the markets. That's the difficult part, and that's the part I'm telling you to go and watch in my previous videos. The other thing you can do And I've put it on here. You can add in an MACD. The MACD is very simple to follow. You've got the center, the 0 line here. You've got the volume going above and below, and effectively when it crosses, when the fast crosses through the other one, it's like a moving average crossover. So you get the one average crossing over the other, and when it crosses over at the bottom here and it points to the upside, then you're getting a bullish run. When it crosses to the downside, on the top here, you're getting a bearish run. And you can normally see with this crossing down to the downside as well, that it's going bearish. Now you see you've got this cross to the upside, you've got this bullish run, it's getting bullish. What this is telling you is it's getting kind of topish as well. And there is a triple top here, but we'll keep an eye on it. And that could still run all the way up. This could still run all the way up to the resistance here. Now you can use an MACD as well. You can use moving average crossover systems. You can use, what else can you use? You can use Bollinger Bands. I hate Bollinger Bands, by the way. You can use Ichimoku. There's so many different systems that you can use, but they're all lagging indicators. So what we use is price action. The other thing to look for in the markets is patterns. Patterns are a big thing. So you can go and download them on the internet. I'll actually put them on the community for you guys to see. But patterns, for example, there's head and shoulders that developed here. A head and shoulders is one of my favorite patterns because you get the shoulder, you get the head, you get the shoulder, and the price will normally move down the same length as the head and then recover. You get the cup and handle. You get a whole number of different charting patterns that you can follow as well. A lot of people follow the candles, but remember, if you follow a candle, you're effectively following a candle to for the next candle. So it doesn't follow the whole chart. So whatever the candle tells you is basically telling you what's going to happen with the next candle, nothing further than that. But candles can be handy because you can see the tells. That means the sellers are getting back into the market. You see the tells on top. You can see that the buyers are getting back into the market. You can see pincer tops. You can see nice double tops. You can see the length of the candle, how strong the selling is, how strong the buying is. I keep my candles green and red because then I can see when the market's bearish or bullish. I don't know why people change the colors or they get psychologically messed up by that. For me, when I can see the color of the trades, it's actually more important to me to see the color of the trades than than to not see them. So I don't know why people get so freaked out. Look at this. Look how bullish the gold is, and you can actually see the green candles moving to the upside, which gives you a much better picture where the markets are going. US 500 looking a bit bearish there. That's how you trade. That's how you work with charting. And if you're not sure on this video how the charting works, go back and watch my previous videos where I show you in detail how you can actually use the charting packages quite well. I go over price action over and over and over again. I've also got a series of videos in there which show you how to trade with indicators, different systems, Fibonacci, that sort of thing. Go and have a look if you want to. That's good stuff. Guys, thanks for watching. Don't forget the market's 50-50. Win rates don't make you money. You need to know the strategy. If you want to know the strategy, go and watch my last video. That will show you the strategy. Then you'll know how to make money in the markets. Till next time, guys. Cheers, ciao, and bye.